Welcome back. At this session, we are going to learn how one economic indicator can be counted as whether bad or good news for the financial markets. Greetings everyone, and welcome to our second trading session from the Interstellar group. Today we are going to talk about one of the most important concepts in macroeconomics and financial markets, which is the business cycle. Throughout this session, we will break down the different phases of the cycle, understand why they happen, and most importantly, why every trader should know where we are in that cycle. But before we start, I want to leave you with one simple sentence. The cycle never lies. So let's ask ourselves a simple question. Every bull market, every crash, every recession, and every recovery, they all follow a cycle. The real question isn't whether the cycle exists. Do you know where we are in that cycle today? That's exactly what we are going to learn in this session. Now let's understand what the business cycle actually is. A business cycle, also known as an economic cycle, shows the overall health and the strength of an economy. For traders, this is one of the most important concepts to grasp. Remember, markets don't react the same day to data all the time. That's why understanding the cycle matters so much for traders. Throughout the cycle, the economy moves through 4 phases: expansion, peak, contraction, and eventually recovery. We will break those down in detail soon. So first image, as I put it here, is a simplified graph to make things easier to grasp. And we can clearly see those 4 phases as I talked before. But on the second image, you can clearly see a more realistic view where the economy moves up and down around a long-term growth line. That's how the real economy behaves. Once you spot those movements, it becomes much easier to understand why markets behave the way they do to the economic indicators, to the speeches, and so on. Let's start with the first phase of the business cycle, the expansion phase. That's when everything moving in the right direction. Businesses are producing more, companies are hiring, so unemployment starts to fall. People have jobs and they feel secure, and they are more willing to spend their money. That's consumer confidence, and it's a huge part of the economy. When consumers feel good, they spend more, businesses make more money, and they hire more as a consequence. And the cycle keeps feeding itself. Meanwhile, growth, GDP continues to rise, credit is way easier to get from the financial institutes or banks, and inflation may start ticking up, but not dangerously. The data usually shows a trend, so things like PMI, employment reports, those positive economic releases. Basically, most of the data is telling us the economy is healthy and expanding. It's one of the strongest phases, but as you will see next, expansions don't last forever. In this phase, we can say the market behavior will be same as equities may rally up and commodities rise to the higher prices. Now let's move to the second phase of the business cycle, which is the peak. This is the stage where the economy has been growing for a while and it hits its high points. Everything looks amazing on the surface. Unemployment is low, GDP is very strong, and consumers still feel confident. It's the moment when almost no one realizes that they are in it. Optimism is everywhere. Investors think prices will keep rising. Consumers keep spending. There is very little bit fear in the financial markets and also the economy when people think the good times will never end. But underneath, cracks are beginning to show. Growth is still positive and it's starting to slow. Inflation is often at its highest rate, and that's when central banks start to shift their stances, moving towards the tightening policy. The economy still looks strong, but the direction is quietly starting to change. And that's the turning point traders need to pay attention to, because the next phase is never far behind. As you can see here, I just put a graph, and this graph illustrates the peak of the US GDP in 2021. And as you can see here, the GDP ratio reached to highest level since 2017 on 2021, which is exactly a pure sample to talk about the peak phase in the economy, as the GDP or gross domestic product, we will talk about it in details in our coming session, was at its highest level on that period of time. So after the peak, we move into the contraction phase. This is when most economic indicators like GDP start to decline. Growth momentum weakens compared to the expansion, and sign of stress may appear. Unemployment rises, PMI numbers soften, and we will dig deeper into these indicators on the upcoming session. I will talk about it in details. And if that contraction gets severe enough, the whole economy can slow dramatically. That's when we call it a recession. It's marked by the lowest growth or even negative growth in the economy, higher job losses, and consumer confidence dropping sharply. Now looking at the next slide, we can see the impact of the 2007 and 2008 recession in the United States. Many people lost their jobs, homes were foreclosed, and public concerns covered the economy. So you even saw people protesting, demanding answers about loans, mortgages, and financial reliefs. It actually shows how harsh the contraction phase can be, not just the numbers on a graph. So the recovery phase is the final stage of the business cycle. At this point, GDP and other indicators finally begin to stabilize, shifting out of the negative territory. Unemployment peaks, then gradually starts to fall. Central banks often begin cutting interest rates to encourage borrowing and spending more money again in the society. And sentiment or consumer confidence start to improve cautiously. People are just testing the depth of the water before jumping in. This actually can be called a comeback, where nobody believes at it first, but it can be the infrastructure, or let's say the base of the next expansion phase in the economy. So now the question is, why does GDP matters to the traders? Because GDP tells us how healthy the economy actually is. As a general rule, if GDP beats the expectations, that can support the currency, boost the confidence, and often push the stocks higher. But on the opposite, if GDP misses the estimates and the expectations, that can pursue the currency and weigh on equities. But it is not automatic. Markets react within the business cycle and with the regard to central bank policies and investors' expectations. So the same GDP number can trigger totally different reactions depending on where we are in that business cycle, or let's say economic cycle. Now let's look at a real example. On October 28th of 2021, the US released its advanced GDP report. Actual GDP growth came in at 2%, while the market was expecting something like 2.6%, as we can see on the top of the slide. Normally, we can unexpected GDP numbers, as we thought on the previous slide, might trigger a risk of move and push the stocks lower. But that's not what happened on 2021. As you can see here, both the S&P 500 and Dow Jones continued to climb. Why? Because the market wasn't looking at the number in isolation. The economy was in the late cycle recovery phase, with the inflation already elevated and the Federal Reserve signaling policy tightening. So when GDP printed lower than expected or estimates, investors actually read it as less pressure for aggressive rate hikes by the Federal Reserve. That actually improved the risk sentiment and supported equities. And as we can see here, Dow Jones started to go higher and higher. The key takeaway is never read one indicator in a vacuum. Always check where we are in the business cycle and how central banks are likely to react, or let's say the market participants as well. That's the difference between reacting to headlines and trading the macro picture. Now, let's put everything together. If you understand where the economy is in the business cycle, you can better anticipate market reactions, and that helps you make better trading decisions. And that's the core focus of our next session, where we will dive into the different chapters, such as how we can read a data when we have different numbers for the actual compared to the estimates and forecasts. Before wrapping up this session, I just want to talk about 4 key questions that helps traders to make better decisions. Know where you are actually in the business cycle, and checking the central banks may help you to know what to trade and how to trade that symbol. Actually, we can say you can have higher win rates in the financial markets. The first question is which asset to buy or sell in each phase. The second question is what central banks are actually doing. Are they cutting the rates or they are increasing the rates? And how they are looking actually to the outlook of the economy. Are they optimist or pessimist? The third question is what data to watch. This is very crucial, and we will dive into it by the next session, and we will talk about it, how to recognize the most reactive data by the financial market participants on each period of time. And eventually, the fourth question is how market will react to the economic data in each economic cycle. So this is the second session for our trading bootcamp, and I want to finish this session by one single line, as you can see here. Each cycle has different reactions to different numbers, and market may weigh some specific data more than the others. So it's very crucial for us to know first where we are in the cycle, how to react to the data, and how to make the best decision on our trades. That's it for our second session of the Trading Bootcamp by the Interstellar Group, and see you next time.